Okay, welcome back. I'll just take a minute and just speak to the team. So this team's actually been together for a very long time. It was the team that Rich put together. We know one another. We like working with one another. We've gone through thick and thin together. And what's great about it, we see possibility. We enjoy our jobs. We see the great future of what's unfolding. What a privilege it is to work in Sibanye at this time, building a significant future. The speakers today, Mel and Ralph, Davy, who's our EVP of the underground operations, Lucas, the processing and surface operations. We'll hear from Babsi, Vice President of Chrome, and then Neil Pretorius, who's the CEO of DRD Gold, will also say some words about DRD. So welcome to the PGM operations. We're going to take quite a long time to step you through very carefully the strategic power of this endowment that we have, how carefully it's been put together. What's the value of contiguous 70 kilometers? What's the value of boundary crossing synergies? What's the value of putting up a team who can take it all in and think about optionality? What do we mean when we talk about scale turning to optionality and optionality turning to value? That's what the PGM program is going to answer this morning. So as Rich has alluded, it's probably one of the biggest single accumulations of metal on the planet. It's 70 kilometers of strike. To get that comfortable view, you'd probably have to be 40 kilometers above the Earth's surface to get that comfortable view. It is an absolutely monster accumulation of metal. Just some attributes. Predominantly, we want to talk about the UG2. So where does the UG2 start? There's an outcrop. Another interesting line is the 1,000 meter depth, which is delineated by that line. And then an unpacking of the strike. And what we're going to show to you today is not only current operations, but brownfields operations, optionality, how we've decided to move in our underground workings, the value opportunity that the surface mining also presents. Historic Merensky tailings dams largely depleted for PGMs. And what does it mean that we have substantial UG2 tailings that have got this endowment of chrome, and what does that mean in terms of value going forward? The blue represents new possibilities, the future. But you're also getting a sense of the convertibility from resources into reserves. It's very low. Rich spoke earlier. What does it mean when Kruendal, now that we own the whole of Kruendal, what does it mean when we can drive a Bambanani workings into Siphumelele? What does it mean when we can drive Kopanang workings into a Komanani? We'll unpack that for you. Down-dip extensions, and then this huge endowment of the Marikana assets. Strike extensions, East 3, East 4. So this is an incredible endowment, and today is all about the opportunities we have created, very carefully considered over a long time. What can we do with boundary crossing infrastructure and synergies? This is the base, it's a substantial base. Yes, it may look like it's peaked and declining. That's our reserve base. Built up from assets that are really well understood and have a history of delivering to expectation season in, season out, up and through the cycle. The Rustenburg endowment that includes the Kroondal now, Marikana, our surface operations. Inside here, we've also got the K4 Marikana reserve, no longer considered a project and is in ramp up. What we don't have in here is the 150,000 ounces mined from Thembalani, as well as the 50,000 ounces mined from Siphumelele. Those are classified as projects, and Ralph will unpack those. But pretty much in 2026, you could add 200,000 ounces in mining on top of that. It supports very long life production. Marikana got 45 years of mine life, Rustenburg 32, Mimosa 8. And today is about, given that endowment, how do we turn scale into optionality, and how do we turn optionality into value? Take a moment to talk about the special ore body called the UG2, especially on our Western Limb. It might not be the same everywhere, but on our Western Limb endowment, what is very special about the UG2 compared to the Merensky? So on the Western Limb, UG2 delivers materially higher value per square meter, about 30% more when one aggregates for all the metals that are recoverable, compared to Merensky. And that's due to higher grades in rhodium, ruthenium, but then very importantly, chrome. What is it that we mean about coarse chrome? What is the opportunity about fine chrome? Merensky, though, is still very important, and it does contribute to a good base, and that also supports smelter balance, which we have to be very cognizant of. And on that contiguous operation, what's very exciting about the UG2 is that these resources are shallow. They open themselves up for mechanized mining, open themselves up for low-cost mining, and that is the future of the Western Limb for Sibanye-Stillwater. So in terms of our mining mix advantage, the UG2 mix does increase exposure to high-grade PGMs, as I've said. We'll talk today, and Babsi will allude to it as well, is this industry-leading chrome technology that the CMA has offered us with Glencore that further enhances margins and cash flow. And that optimal reef mix matches overall value and strengthens the competitiveness of our integrated SGM portfolio. So we believe the future is very much UG2, and it's the foundation of a more valuable and competitive PGM business for us. Ralph will talk about the projects, but just very quickly, we've got several mining projects at various stages along the confidence curve. We've spoken about Siphumelele and Thembalani. Those projects are in reserve. In fact, they're in execution at the moment. East 4 on the Marikana side, followed by Kopanang Extension, East 3 Extension, Batupele, as well as Safi. And later on in the presentation, you can see the production profile that will come from that. So very well thought through, very well understood in terms of timing, capital application, and bringing that into reality. So our job is very much to bring that into reality. You know, it's not just about thinking, so what is our track record of execution? And that is the K4 project. So we do have a track record of bringing projects into reality. Secondary mining projects, we'll talk about a very special concentrated WLTR, how we're going to repurpose that concentrator to exclusively look at UG2 surface material processing for largely chrome into the future. And then also processing projects. We have upgrades to our PMR, or precious metal refinery, as well as optionality over the smelter. So in the downstream of our precious metal business, there's headroom over the BMR as well as the PMR, and smelter that's under study to see optionality moving forward. So we are positioned to unlock sustainable value through the disciplined execution and strategic leverage. This is the underground production profile looking out pretty much 10 years. Currently, our Merensky UG2 mix is largely in favorable of UG2. But you can see it's very much conventional. Higher cost, deeper. And into the future, what we're adding to the endowment to continue the 1.5 million ounce underground production. More UG2, but fundamentally more mechanized. Lower risk, lower cost, shallower. We're a substantial South African, and proudly so, a South African PGM producer. We're currently 27% of the South African production. In terms of the prill split, we're very well positioned. And in terms of the revenue basket, that's chrome revenue, but not chrome production. A substantial amount of our chrome does move into contract arrangements with Glencore. So we've got a very high quality metal basket. Our chrome management agreement further strengthens our position in chrome recovery, and we're actively investing to sustain and grow our competitive position in South Africa. I'll now hand over to Dawie to take us through the underground production. Thank you.
Thank you, Rich, and once again, good morning to everyone. I'll be giving an overview of our current PGM operations, and also tomorrow during the underground visit, hosted the various teams at our Safi operation, at our Marikana operations. So just looking at our PGM operations, as was said, a strike distance of approximately 70 kilometers, striking east-west from the town of Brits up to the town of Rustenburg. Situated in the bottom part of the western limb of the Bushveld complex. We started our PGM business in mid-2016 when we acquired Aquarius Platinum. Later that same year, we acquired the Rustenburg Platinum mines from Anglo American Platinum. And in 2019, we acquired the Marikana operations from Lonmin. That then concluded our PGM strategy at Sibanye-Stillwater. Our ore body is homogeneous, so what that means, it stretches all 70 k's from east to west, and it's got a constant dip of about 9 degrees, dipping from south to north. Our underground PGM business consists out of 6 trackless mechanized operations and 8 conventional operations, and we employ in the region of about 44,000 people, both own as well as contractor employees. Our PGM ops have an excellent track record with regards to delivery as well as cost discipline. From the inception of our PGM business, our operations achieved market guidance on an annual basis. In 2021, we did see a slight drop in production, and that was due to the closure of 4B at Marikana, as well as our Sibanye shaft at our Kroondal operations that reached end of life. However, this was partly offset by the gradual build-up of our K4 operations at our Marikana ops. Optimization, restructuring, and a simple operating model resulted in a right-sized PGM segment that operate on the current footprint with an exceptional culture of cost discipline. If you look at our rand per ton, including our surface operations, is the lowest compared to our peers in the South African industry. Our operating cost per 6E ounce rand comparable to our peers, although the switch from POC to toll at our Kroonal operations in 2024 added additional costs. Our increased stay-in-business capital spent per 6E ounce also ranks below 2 of our peers in the industry. Throughout the years, the responsible investment supported our production profile and also ensured our sustainability. On average, for the last couple of years, we spent in the region of about 4.5 billion rand for our ORD and SIB capital requirements within our region. Our stay-in-business capital per 6E ounce also compare very well with our peers since 2023. This is a slide that we're very proud of, and being part of the PGM business since inception in 2016, we've actually seen how our organization and how our PGM part of our business gradually moved down the cost curve. From where we started in 2016 to the furthest to the right, 2020, showing some marked improvement down the cost curve, and currently, ranking in the quartile 3 of the cost curve, taking into consideration, excessive capital, project capital being invested in K4 as well, but very determined that going into the future, we can move further down, especially in lieu of what Richard showed us, and which Ralph will show us later during the day, the new projects that's coming online, and also taking into account that the majority of that will be trackless. We see ourselves moving down and being very competitive with world PGM producers. Our K4 shaft is a well-advanced brownfields project that we acquired from Lonmin. Our K4 shaft is currently still in build-up phase, currently mining with 64 crews, whereby steady-state production in 2032 will require us to mine with 107 stoping crews. At steady state, our K4 operation will break about 39,000 square meters on a monthly basis, waste about 190,000 reef tons, which equates to about 21,000 4E ounces per month or 250,000 ounces per annum. Our K4 shaft at steady state will employ about 4,500 employees, which is critical for the socio-economic stability within the area which we operate in, and has got a life of mine up until 2070. Also important to note is that our K4 shaft, the project is 77% complete, and we've got just under R1 billion of project capital that we still need to spend, from which 650 will be spent in 2026 and the remainder thereof going into next year. At steady state, K4 will produce a reef mix of about 55% Merensky and 45% UG2, which is key for our smelting strategy within our PGM segment. If we look at our primary mining outlook, as Rich showed us, it is a dropping profile, but also very important to notice that this excludes our projects, which is East 4, Siphumelele, as well as Thembalani. Despite the declining profile, our costs that we forecast will remain competitive, and we believe as a team we've demonstrated that we can manage costs since the inception when we started our PGM business. If we look at our capital profile, so the capital graph here excludes our project capital for K4. It includes K4, but it excludes Siphumelele, Thembalani, and East 4. In general, our strategy in spending our capital is that at about 9% of our total operating cost, our SIB is calculated at our TMM operations and at 7% at our conventional operations. Our SIB is mainly spent on infrastructure maintenance as well as TMM replacement as at our trackless operations. Our ore reserve development at our conventional ops are also capitalized accordingly. This brings me to the end of the the operations, I'll now hand over to Ralph that will take us through the project portion.
Thanks, Davy, and good morning, everyone. I think what's quite exciting for me is seeing our K4 project, which in the half-year results will show actually will have a positive contribution from this year onwards. So that's part of the good news as we keep on developing these projects. So Richard and Davy already spoke a lot about these, and so I'm just going to re-emphasize these points again. So what we're going to demonstrate is these projects are higher margin projects. They are with low capital intensity, because most of them are brownfield extensions. And the one thing which we don't show you today is the Merensky overlay. And that's very important because our UG2 is still relatively shallow towards where we've mined historically, but also it allows us to understand the geology and structure also very good of where we are going to mine with the UG2. All these operations except East 4 will be extensions from where we are mining again, which makes it easy as we're moving down dip. Also, because of the Merensky, we have significant amount of legacy infrastructure we are utilizing again, which brings the total capital ask down. We're not trying new mining methods, so we know quite well how to do mechanized low-profile bore and pillar mining, and with that also comes experienced workforce. That's one of the other benefits we have by operating in this brownfields environment, which is going to assist us tremendously as we ramp up these projects and these crews move down dip. Reduced complexity I'll show you today, and I'll use Sibanye-Stillwater as an example, where we actually also have the ability to combine mines to become one solid mining unit again, and also bring us quite good return on capital and payback. Richard already showed this slide, just to re-emphasize that Sibanye-Stillwater and Thembelani are already in execution. Thembelani we already have stoping crews in the area, so it's already contributing towards revenue. And you'll see basically all of them except Thembelani will probably be the last pure conventional project which has been approved. And then Lucas will talk more about our other secondary mining projects, and then it's important you see these numbers. If you go in your book, if you look in the maps, you just follow the numbers to see where these specific projects are. So for today, we actually used these set of prices you see here. All of them are based on a hurdle rate of 10%, real 2026 terms. Commodity assumptions are based primarily on the UBS, April 2026. Iridium, ruthenium, and lithium are on the SFA Oxford assumptions, and chrome we used CRU prices. If you want to see the full deck, it's also available in the appendix. If you want to do your runs. All right, so we start to color the map a bit in. So what you can see, basically, these green areas are where our project areas are. On this slide, I'll just very quickly go through again, starting with Thembelani, which is right on the western side. Then you have the Kopaneng extension. You'll see there's a 6, which is a Batupele extension, which I will discuss a bit. Then we have Sibanye-Stillwater, Bambanani area, K4, which Davy already spoke about. Then go right on the eastern side, we have East 4 is exciting, that will be our last decline from surface. East 3 extension, where we convert from a conventional to a mechanized mine, and lastly, Safi extension. So these projects are quite well advanced, so East 4 is already in feasibility, while the other projects are in pre-feasibility except Safi, which is still in concept study. If we focus on the traditional Rustenburg area, which is in this area, starting with Sibanye-Stillwater, again, we have the Sibanye-Stillwater project. Actually, we have 2 different phases. So phase 1 was approved last year, and with that, there is to create this whole Bambanani Sibanye-Stillwater as one mining unit. So Bambanani decline will roll into Sibanye-Stillwater, That will allow also our current Bambanani crews to go underground at Sibanye-Stillwater 1 shaft, where currently they have to traverse 6 kilometers to get to the face. That will actually allow them to get to the face much quicker, and we expect the efficiency improvement of up to 20%. If we then move to number 2, which is the Thembelani, it's literally these stoping crews currently mining in these top areas. They will move down into this area. We've already been busy with this project for a couple of years, and the last capital was approved this year. Lastly, but not the least, still in pre-feasibility phase is the Kopaneng extension, and also this project, we will approve the capital on different phases. It also allows us to bring potentially Batupele extension in here, and I will discuss that a bit more later. If we look in terms of synergies, so we spoke about Bambanani decline, which will over Sibanye-Stillwater. That will allow the Sibanye-Stillwater, the crews of Bambanani to go down in Sibanye-Stillwater, get quicker to the faces in this area, start mining. So this is already in our base case, but we allow for these crews to become more efficient, while we have additional Sibanye-Stillwater front starting here with mechanized mining, which will go here as a phase 1 and the ultimate later phase going deeper. Moving next door, we sit with Kopaneng. Same with Kopaneng, we have now the opportunity to punch Kopaneng through into this specific area, mine out this whole blue block. Recently, which is also part of the pre-feasibility A study. So when I talk about pre-feasibility A, it's just this early stage of pre-feasibility. We will still analyze alternatives to make sure we take the block out to the best of our ability. We've done significant work to understand Kopaneng 1, which is already decommissioned. How does it look, and can we not punch Batupele through here? There's still the umbilical core of Kopaneng 1 is still there. There's a whole decline, old decline, legacy decline sitting there, which will allow us then to connect Batupele to get into that deeper ground as well. That will allow us then to optimize the boundaries even further between Batupele, Kopaneng, and Thembelani. This is the long tail of Thembelani, and we get sort of a more balanced production out of these. And then lastly, at number 2, it's Thembelani, as discussed, which is already the last remaining conventional project. If we go into the individual projects itself, so Sibanye-Stillwater, the first extension, sitting in this orange block, that has already been approved. We have capital for that. That's a 2.8 billion you see there, and the NPV IRR is actually just for that orange block. So it's not the deeper area, which is the phase 2, which we would, I'll discuss in the later slide. We achieved our first blast in the Sibanye-Stillwater in May 2026. That's a month ahead of schedule. Then the Bambanani decline, which also needs to hold, that's actually also ahead of schedule as I stand here today. And we expect first production in the Sibanye-Stillwater extension area March 2027. Planned capital footprint completion January 2031. And below quite a healthy IRR and NPV as well. If we talk about the Sibanye-Stillwater extension, that's extremely important. That will allow us actually to increase our capacity at Sibanye-Stillwater because we have additional face, so we can put additional crews in, and that will allow us to take our current production profile at Sibanye-Stillwater, which is 120 kilotons per month to 160 kilotons per month, while we're mining out the tail of Bambanani also at the end. And again, just explaining what the combination of these two historical mines create in terms of having one mine and maximizing the reserve extraction. Also quite a healthy IRR and a relatively healthy NPV as well. In section, so if you think about, I've showed you the plan, so if you have to slice through in the middle and just look at how we combine these mines. I spoke about Bambanani decline coming down from surface. These are all existing shafts already in place as part of the old infrastructure. Bambanani is already 6 kilometers to get to that point. The fact that we're going to hold Bambanani allows Bambanani people to go down and actually get quicker to the face. This hashed area is all the Merensky already mined out. So Merensky, there's a bit of Merensky right, left at the bottom. That's conventional, taking about 40 kilotons per month. But what's more important is the establishment of the first Sibanye UG2 mechanized mine. Again, thank you to the old Anglo-American, which is currently Valterra. There's a lot of infrastructure. We connect up in here, and actually we can use that, and then later on also extend our phase 2. What I don't show today, we have optionality to do a phase 3 in future as well. So that's not in the profile, that grey area. The orange and green you will see in our profiles. So if you look at, let's call it the Bambanani Siphumelele combined mine. First of all, I also didn't discuss this. If we didn't do this, our Merensky would have died down about here, because that would have become a negative, because the Merensky would not be able to actually contribute to the shaft overheads. The fact that we do that, we can mine our Merensky as well longer. This is the Siphumelele phase 1 area. This is the associated capital. So we have capital spent, and from 2030 onwards, it will become just a going operational concern. This is the Bambanani, and the fact that we have held now, we can allow Bambanani also to continue. And as discussed, the Siphumelele phase 2 on top there, that allows us actually to increase our production in the Siphumelele area from 120 to 160 kilotons. If we go to Kopaneng, that's the one in the middle. Exciting, as discussed, we're still in early pre-feasibility study phase. There's only 2 alternatives we are looking at. So I'll first going to explain the one which you see the financial valuation on. This is punching through Kopaneng and extract this whole piece of ground out of Kopaneng. This area, we don't need to go and ask for project capital. There's a workshop which I'll do and stay in business capital. And that will allow Kopaneng already to utilize this ground from 2028 onwards. So the actual project area starting from this pink here. Now, if you can't see clearly, but you can see basically there's the old Komanani 2 shaft, so the Merensky is far here. That's extremely important. That again allows us to create a link from Komanani 2, which is in care and maintenance, so that shaft is still accessible, and actually create connection all the way back through a chairlift. So this is an existing decline. So it's just to go and to refurbish that, connect into our working areas. So first one will be on top here. That again will allow us then slowly but surely to maintain efficiency for our mechanized crews coming down in this specific area. As we move in this purple area, we know we will require a new ventilation shaft. And we also have different options there. So we're looking at a new shaft, which we can also potentially equip, or alternatively is to actually to recommission the decommissioned Komanani 1 shaft, which again gives us optionality by utilizing the old infrastructure. If we're successful with Siphumelele, the Siphumelele decline, although you see it's there, it will come in here, it will connect from this side in here, will go down in the old Komanani 1 workings. And from there, this decline will push through. We will then rebalance the boundaries and actually allow for Tembelani ground to be ceded to the Batupele extension. And we will balance the production through those 2 specific declines. But as is, this one I explained, again, a healthy IRR and also quite a good NPV and a significant life of 27 years. If you look in section, same story again. Merensky has been mined all the way up to Komanani 2, which is in care and maintenance. This shaft, Komanani 1, is decommissioned. And extending with our down dip with our UG2 all the way. There's also a phase 3, which we don't show today. So again, we just talk about this. So everything we show today is still what we call in shallow to intermediate depth. So we haven't started to touch any deep level type of PGM mining. If you look at any of these infrastructures I show. The other thing I also didn't mention, the beautiful thing we have in the Rustenburg Marikana area is the dip of the ore body. It's between 9 and 13.5 degrees. That allows us to actually to continue with mechanized mining without trying to do some real funny stuff to make sure our TMM machines can run there. Moving to Thembelani. So the project area, if you have an isometric view, that's Thembelani 1 shaft. That's a ventilation shaft. Then we have more ventilation shafts. You have a main haulage, then the decline going down. Merensky operations, what you can't see here is Thembelani 2 shaft, which was sunk in the old days. It is connected with Thembelani 1, and it's important because part of our project, we use the refrigeration plant there actually to ensure we have refrigeration for the ventilation crew, for our stoping crews moving down. Project areas in this green block here, that's where our current UG2 operations are, that's where the current Merensky operations are. We already have stoping crews already settled in these areas here, and so even in the project area we started to generate revenue. Still quite a long life, so this allows us to take Thembelani to 2057, and again, quite a healthy IRR and NPV. If you look in section, same story, Merensky Reef has been mined out. We had to, all this infrastructure had to be established for the Merensky, and now we can utilize this infrastructure for AOG2, the current mining, and now moving down in this green block. Future mining, the biggest job here from a project perspective is to upgrade the current decline from 70 kilotons per month to 140. That's what we're busy with. And then also to set up the new dirty water handling system. And lastly, to ensure we connect the refrigeration of Thembelani 2 to actually mine these areas. In this case, it made sense to keep it conventional. With the conventional crews, they just moved down with the current shaft. And hence the reason we kept this as a conventional mine going forward. Thembelani 2, so this allows us then to maintain a healthy profile for quite long. And then significant upfront capital, but then after that, it's just normal ORD and stay in business capital, which will continue after that. Moving away from Rustenburg, now right on the eastern side, starting with East 4 and East 3. Again, East 4 is this project area, but we've broken it up in a phase 1 and a phase 2, just to ensure we spend capital responsibly. And then we have East 3, which would be the change from a conventional mine on top here to a mechanized mine, which will come down here. We've done significant concept studies over the last couple of years, and to see how we can balance this piece of endowment and actually to get balanced production between East 3 and East 4 in future. Both of those declines will build up to 200 kilotons per month. Both of these mechanized mines in the future. If we go into the detail, so first of all, I spoke about East 4 is basically our last decline from surface. So we get the benefit to do everything from new without having infrastructure on top of you. We are aiming to have the feasibility completed by the end of this year. And then hopefully we can make it part of the PGM portfolio as part of our project execution plan. Aiming 200 kilotons per month in this specific block. East 3, our biggest work is to see how we can convert this historical, conventional incline system to convert it to mechanized low-profile mining, and also to upgrade the capacity to do 200 kilotons per month. East 3 is in pre-feasibility, while East 4 is in feasibility. So East 3 will only come later in the following year to the board. Zooming into East 4, it is one of our bigger capital items. Sitting right on the eastern edge, just the landscape on top of that. One of the things we've decided to do here, instead of having a haul road back to the EPL plant, is actually we will put in an aerial rope conveyor that take the congestion off the roads and obviously make it also much safer, and also to convey it over farmland. This same aerial rope conveyor will connect with East 3, so East 3 will also get the benefit of that in the future. And from there, we will transport the ore to EPL, or the EPL concentrator. Although quite a big capital bill, still quite a healthy IRR for East 4 at this stage. So our intent is to ramp up to 200 kilotons per month, which will give us about 120,000 ounces per annum. It is quite a slow ramp up to 2032, but we made sure that what we put in here is achievable. Significant capital in the initial years, and then after that, it would only be the stay in business capital. If we go to East 3, as I already discussed, the big issue there will be the conversion of the shaft from a conventional to mechanized mine. East 3 get the benefit of the conventional base, which will still happening for the next 10 years or so. Again, a healthy NPV and IRR. If you look in section, basically we exploit the whole piece of ground. So this is the current East 3 conversion in this specific area. So that's where most of the capital will go down. In future, the East 3 Phase 2 and East 4 Phase 2 will share synergies in the same ventilation infrastructure. That will allow us to go deeper. But just to put in perspective, this is still very shallow. Even in 2065, we will only be a kilometer below surface. And then there's some small area left remaining after that. Lastly, Safi, I don't have a profile here, but Safi is in concept study. Economics in concept also looks relatively good. What's important is this blue is remaining reserve for Safi, so you can still see this significant mining in the top left, which will keep them busy for the next couple of decades. However, we don't wait. We are looking at ways, we are looking at ways so we can get the best extraction strategy below at Safi. So what we are looking at, and that's more around infrastructure. This is quite a wide strike, so do you put in one decline or two declines? But this will also be mechanized mining. And then the light green below, again, is for future. But again, if you see where that 1,000-meter mark is, this is a significant piece of ground which we will exploit in future. And obviously, that's also where we will go tomorrow to see the Safi operations. Capital spent for these mining studies will hover around 3.5 billion up to 2031. That again excludes those deeper sections I've shown. So again, it creates optionalities for us where we can use it as a replacement in the future if it makes sense, or for whatever reason PGM market changes where we can bring some of those projects forward. But at this stage, we keep it disciplined. And one thing we've done at Sibanye-Stillwater over the last years is to create project capacity, and we will keep on creating project capacity as we continue with this. As Davie already alluded, the good news is we have experience in building projects now through K4 as well as Keliber. And a lot of our project individuals are actually looking at both international as well as South African projects. This is my last slide, so I'm going to hand over to Lucas, and he will also share some of the projects, but it is an exciting time to be in Sibanye-Stillwater for projects. And I'm looking forward to deliver these on behalf of Sibanye-Stillwater. Thanks, Lucas.
Thank you. Thank you, Raf. My name is Lucas Msimanga. I'm the EVP for processing. You would have heard a lot from my colleague Davie talking about the mining output. You also would have heard about the good projects that are coming through. Raf has gone through them, quite extensive. As processing, obviously, we need to process this and make it worthwhile for the miners so that they are producing something they can be proud of, and something that is usable and sellable by Kleantha as well. So I'm going to take you through the processing operations in terms of the capacity and what we're doing there. If you look at our operations, we've got a vast footprint which is actually distributed across the Marikana as well, the Rustenburg region. And in here, you have concentrators for primary processing material from the underground operations. You've got also concentrators that are also dealing with the retreatment of tailings. So it's a robust portfolio actually depicted by these black headings here. And what we have as well is the smelter. So we've got a smelter as well, which says we're not only involved in concentrate production, but we also process further, which is part of beneficiation. So we've got a smelter, we've got a base metals refinery, which actually refines the material further as well. This is actually situated in Marikana. And down in Boksburg, you've got the PMR, which is the precious metals refinery. So again, what this shows you is that we've got really quite a chain from the concentrator up to the finished product in the refineries, which means that we can produce products of different quality as well, and finished products which can be marketed and extract maximum value. But also important for us is that we need to deal with the tailings, in a responsible manner, environmentally. So we've got in orange here the different tailings facilities. And I can confirm as well that these are managed very, very closely and actually compliance from a global GI STM standards. So this is actually well looked after. So we've got a vast processing facility which is actually adequate to process the current projects, but also the future projects. I'll go a bit into detail in terms of the underground concentrators. These are the concentrators that process material from the underground operations. In Rustenburg, we've got K1, K2, as well as Waterval UG2. In Marikana, we have Kari Mix, Kari UG2, K4 as EPL, as well as APL. In terms of capacity, in the Rustenburg area, you can see there's actually spare capacities. So we still have got spare capacity in Rustenburg. And in the Marikana area, it's actually breaking even in terms of what is being received. But also to note as well in Marikana, we've got 2 concentrators which are on care and maintenance. These concentrators have been preserved and will be restarted as part of the strategy as the projects come through. So the key message here is that we've got the capacity and we can dial in more capacity as needed. Also important as well is that this is actually attached to the TSFs, and these are long-term TSFs. I mean, you can see in particular Marikana pits, this is quite strategic going forward, going to 2060. You can see 2044, the Hoedspruit, Paterskraal, 2060. So we've got the capacity for the tailings to dispose those tailings safely as well as environmentally friendly. We talk about chrome. I think my colleagues have spoken about chrome. We see the chrome business as being important going forward. And the processing of chrome and actually extracting that value becomes quite important. You can see the UG2 tailings. These are the active chrome plants across. And I think interestingly as well, you'll see here is the recoveries. As processing, we're continuously seeking to improve the recoveries, benchmarking internally as well as externally, and obviously we want to raise that as high as possible. This is in line with the operating excellence that Richard spoke about. And again, here you'll see a standout here in this plant here, which is actually at 36%. It's much higher than the rest as well. And our objective is to actually get close as possible to that. And this we'll do obviously by optimizing our operations and actually employing the right technology. Now, Raf spoke about a number of projects, very good projects, which will ensure that we are sustainable into the future. But what is quite important as well is that those projects, they've got to find a home and actually be treated. What you see here is the numbers, actually those projects that Raf spoke about. And on the left here, you've got the Siphumelele, Batopele, as well as Tembelani. And these projects, they go to Waterval UG2. And if you come this side, East 3 and East 4, they go to EPL and EPC. And all the other projects as well, they've got a destination in terms of where they'll be processed. So again, we know where that material is going. We've got the capacity, we've got the ability to process that output. And like I said, we've got the tailings treatment capacity as well. So we've got concentrators that are treating primary material from the underground operations, but we've got also concentrators that are also treating the tails that we have. So that's a substantial part of our business as well. So what we have in the Rustenburg area, we've got the WLTR as well as Platinum Mile. We see WLTR as important going forward, and the projects as well are in place to actually use that to, especially on chrome, and extract more chrome going forward. We've got BTT as well as ETTP, which is actually in Marikana. And we've got also the spare capacity as well within this. So that means we're not only processing the primary output from the underground operations, but also our business is also processing and retreating material from the tails dump. And again, this is associated with the TSFs as well. I think interestingly as well as an opportunity, you'll see in these concentrators, we are not yet doing a lot of chrome. But again, this actually poses as an opportunity going forward to actually expand this business here and do more chrome also in the tails retreatment capacity. Now, for us to be able to treat the material that comes from the projects and comes from the operations, we need to have the capacity. So the capacity is ticked. But also what is important is that we need to have the right reliability, the availability, so that we've got stability in the operations. It means that we need to invest into our operations so that we get that reliability. In the processing side, reliability is quite important because for you to have stability, enhance the efficiencies, enhance the operating excellence that Richard is talking about, you need to have the operations reliable. So we've maintained a discipline and consistent capital investment in the processing infrastructure. And again, you can see over the years as well, spent in the concentrators. And what does it give us? It does give us that availability which is needed. And you can see from 2022, our availability has actually been the north of 92%. This is enough, and this is what is required as well to meet our business plans. And if you look year on year, we've been able to treat all our stockpiles. So whatever is being produced, we're able to push it through the concentrators and process and convert into final product. Now, this is the exciting and interesting part. We've got historic UG2 tailings. We've got them in abundance, and this is some of the deposits that we have. This is in million tons. These are UG2 tailings which exist in the Marikana as well as the Rustenburg region. So we're seeing a resource here, and a very good resource. And if you look at it in terms of the chrome content, quite very good figures. But over and above the chrome, there's also PGM content as well. So we really see quite a very good opportunity in these facilities. Now, the major value that we see is chrome with a meaningful PGM upside. And what this does is that, well, you can be able to extract chrome and also extract the PGM. And also as the prices actually fluctuate, we can actually make up to some of those gaps. So we see that as a wonderful opportunity going forward, an opportunity where we need to extract value from. And again, like I've said, the existing concentrators, WLTR as well as K1, they do help us in terms of extracting and recovering the PGMs, and they do it very, very efficiently. But we're saying the resources also represent a significant opportunity for chrome recovery through the application of suitable processing technologies. So it means that we have the resources, but how do we extract that? How do we convert that to value? The first part is technology. We need to deal with technology. How do we deal with technology? So the conventional methods in the industry have been using the spirals, but this has proven to be quite effective on the less, but not very effective on the finer chrome. Now that's why there is a switch in terms of technology to the magnetic technology, which uses magnets. And this breakthrough in technology allows us to extract that opportunity in those deposits. So in terms of technology, we are implementing the fine chrome recovery technology across our UG2 processing operations. And again, this is proven technology. It is there in industry, and it has shown that it can give us the extraction that we need. But also importantly, it does actually give us better recoveries as well. And obviously, the higher recoveries will actually give us more output. Also, interestingly as well, because we're extracting the chrome as well, we're also going to be reducing the tails volumes. And obviously, from a rehabilitation point of view, it's got a positive impact up to about 30%. And this enhances the overall economics of the operations. The chrome management agreement with Glencore supports the ongoing optimization of chrome production and value extraction. So we've got the resources, we've got the technology to deal with that and process that material. Now, important as well is that when you process as well, you need to deal with the tailings. These tailings have got to find a home. We've got to be able to handle those tailings. Our technical team has done a very, very good job in developing a digital twin for the SA PGM footprint, which has helped to optimize disposition planning as well as the long-term capacity. So this has helped us as well to optimize this tailings deposition. And the Marikana pits, they are a cornerstone in terms of handling the tailings. These are pits that are existing. So it means that in terms of time to bring those tailings facilities, they can be brought quicker and also at a lesser capital. So we can deal with that in these Marikana pits TSFs. And they will help us to maximize deposition capacity for the WLTR and Krundal surface concentrators while supporting future underground operations. So we've got the resource, we've dealt with the technology, but also we've got a solution for the tailings disposals. Now, this talks to the project to actually actualize this value creation. This WLTR recovery plant upgrade is one of the projects. And again, what I'm talking about here is phase one. The phase one is actually here, and you'll see it from the processing rate that this is only part of the surface, the processing strategy. There's more in Krundal, there's also other phases as well. But I'm going to talk a little bit about this phase one here. So this phase is going to be treating tailings from KTD1, recovering both chrome as well as PGMs. This project enhances overall value from the surface operations and supports the broader SA PGM surface retreatment strategy. So the feasibility study has been completed, the board approval has been received, and construction is to commence in H2 2026, with commissioning expected by the end of 2027. The projected capital is about 0.9 billion. The payback is over 2 years. The economic life of this phase is 6 years, NPV of 1 billion, IRR of 43%, and very competitive operating costs as well. And what this shows here is the layout of the plant, and this shows the profile going forward. Again, it shows the potential in the system, and that this is a multi-year profile as well, which is actually being extended going forward. And now, this move and change in strategy or enhancement on the strategy, it represents a transition from Merensky Ridge to UG2 tailings, driving a fundamental change in the revenue mix, with chrome becoming a core value driver alongside the PGMs. The surface margins as well, they're expected to improve as well by this strategy. But you can see the shift as well, with chrome becoming important, but also PGM also being there. This is actually the stake of the projects at Crandall as well as WLTR. Again, we've employed capital as well to prepare for this storyline. You can see the spending at WLTR, Crandall, as well as the Marikana pits. So there's been investment to actually support this unlocking of value. Again, in summary, we've got the resource. We see potential in the resource. We've got a footprint as well, which is actually properly positioned as well, and the synergies and that can be got in the area as well can actually be extracted. The CMA actually provides actually the opportunity to actually partner as well as and extract this value. And again, we've got an integrated disposition strategy supported by the digital twin planning, which really optimizes the extraction of this value. I'll stop here for now and ask my colleague Babsi just to take you through onto the detail of chrome. Thank you.
Is this thing on? Good morning, ladies and gentlemen. I've got the privilege to take you through our chrome business this morning, both where we come from, but also where we are going. It's quite exciting stuff. So let me start with just a bit of history in terms of where we come from and where we are going. So chrome is a material and growing value contributor to our revenue base. If you look at 2020, about 3%, all the way up to about 12% in 2024 and 8% in 2025. It's also been a stable income generator during periods of low PGM pricing. If you look at the EBITDA graph below, in 2024, that's all the way up to more than 40%. And then lastly, a critical enabler of our project feasibilities. We've spoken about quite a couple of projects, and each of these projects has got a material chrome component, which contributes to the value. Not only that, also to reducing or extending life of our tailings facilities. Tailings facilities can be a very costly capital outlay, so by taking out more chrome, obviously those can be extended. In 2025, we signed, we call it a chrome management agreement with Glencore. And this agreement attracts material value to both Sibanye and to Glencore earlier. So firstly, it repositions commercial terms of let's call it legacy contracts, such that both Glencore and Sibanye attracts a lot of value earlier. Glencore in terms of more chrome volumes, and Sibanye in terms of getting out of that contract and attracting market-related pricing quite sooner. Secondly, it creates an opportunity to join forces in terms of technology, in particular as it relates to fine chrome. And then thirdly, it creates synergies through combined assets via a couple of things. R&D capacity, capability and infrastructure, which Glencore are very strong in, being a chrome company. Technical capability and capacity. And then lastly, chrome recovery infrastructure. Sibanye has got 12 chrome recovery plants on our footprint, and Sibanye owns 6 of them, and Glencore owns 5 of them, which means working together, there's a lot of synergies to be leveraged on. Let's go to the next one. Right, if we look at our existing chrome profile, so what does existing mean? This is what we have in our approved life of mine, including approved projects. I think the first notable item here is the significant growth that we've experienced since 2016. So in 2020, we did about 1 million tons per annum. 2024, about 2.5 million tons per annum. And if you look at the forecast up until 2023, circa 2.3 million tons per annum. In 2023, we will be exiting some of our legacy contracts, and that will result in a big upside in terms of value. One thing that we need to take note of here, still a large portion of our chrome is sold at prices. Where's this thingamajig? Yeah. If you look at the green here, all of that chrome is still sold at lower than market prices. The remainder is market-related prices, and in 2032, we will exit that contract and will attract market-related prices on all our chrome. Good, if we move to the next graph, this one is quite exciting. So the grey you see here is the graph that I've just shared. And it shows our growth plans into the future, both extension projects, underground extension projects, as well as our surface projects. So our expansion plans will result in a 75% increase in our chrome volumes. This will enhance Sibanye's position in the local as well as global markets. The expiry of the legacy chrome delivery contract with Glencore will result in a significant increase in revenue from 2023 onwards. There you can still see that area there. It's important to note that all our expansion projects, regardless of the expiry of the Marikana contract, will attract market-related prices, and that's for both surface as well as underground. So, ladies and gentlemen, chrome production has become an exciting and important portion of our portfolio. From 2016, where we produced 1 million tons per annum, we are on the path to produce 4.5 and even more than that million tons per annum, which, we are on the path to be a chrome producer, to be reckoned with. As Cleantha mentioned earlier, we currently do 10% of South Africa's chrome production, 5% worldwide. If we achieve this, we will exceed that 10% by quite a significant amount. So that's my story on chrome. I think I need to hand over back to you, Lucas.
Thank you, Babsi. We're quite excited about the chrome opportunity. So we've spoken about the concentrators, both underground projects, also the tails treatment, the opportunities that exist there. And we've spoken about that we've got the capacity, we've got the quality operations, which are actually in very good condition. I just want to spend a bit of time talk about the downstream. I think what is exciting with our portfolio is that we don't just produce the concentrate, but also we beneficiate. We actually go a step further. And this is in line with what the government is requiring from us, and also in line with extracting the most value for our shareholders. So I just want to draw your attention to the base metal refinery as well as the smelter. And we say it in Boksburg as well. We've got the precious metals refinery as well. So we have end-to-end beneficiation capability, which stretches from the concentrator, smelter, BMR, and PMR. We've also invested in reliable, cost-effective processing assets that support long-term operational sustainability. The third-party processing also provides capital flexibility and optimizes value by utilizing available capacity across the value chain. I want to talk a bit about the smelter performance as well as on its reliability. The smelter is currently operating at 78% with very strong reliability. And I must mention that since 2017, we haven't had a significant failure. So I think there's very good control, very good capital that has been invested over the years. So the operation is well looked after, and it is a stable furnace as well. And with stability comes efficiencies as well. And with efficiencies, we're able to manage our costs as well. And this has been achieved through targeted investments, which have improved throughput as well as stability. The BMR and PMR are operating at 50% capacity, providing headroom for volume growth and product flexibility. PMR upgrade is key enabler for long-term sustainability and processing optionality. I'll talk a little bit more about the investment into this operation as well. Now, this shows the capital that has been employed over the years at the smelter, BMR, as well as PMR. And you can see over the years, these assets have been well looked after. There's been investment into them. And I can confirm that they are in a very good condition to actually deliver the strategy. I think as an example as well, if you look at the furnace reliability and just looking at tons between failures, significant failures, this actually has been improving over the years. And this has been achieved because of the great attention that is paid to these assets, the capital that is employed, the very experienced and well-trained people that are running these operations. I want to talk about the PMR upgrade as well. And I think quite important that these assets are kept in the good condition. And by the way, these are mature assets, in number of years. So it is quite important that they are always refreshed to be kept in the same condition. But more importantly as well, it has not only been about keeping them in the same condition in terms of reliability, but also in terms of upgrading them, modernizing them, and actually improving them so that they can constantly increase their capability of actually doing new products. And what we're really focusing on as well is because of the portfolio that we have and the basket of minerals that we talk about, or metals, we have to be able to process the full basket of the precious metals. And this upgrade as well has also focused on aligning with the life of mine, ensuring that all those projects and all the life of mine is actually met here. So this project has actually been geared to provide that. We've also included the upgrades on the laboratory. The laboratory is very important for this operation. It is very important in terms of managing the customers as well, ensuring that we keep the right name. Also the upgrade on the ruthenium circuit, as well as the rhodium, as well as the iridium circuit. This has been pushed, and importantly, to align to the strategy, a focus on operating excellence. And in processing, it is really about improving recovery, efficiencies, and product flexibility, and that talks to the unit cost as well. The total project capital estimate is 2.3 billion, of which 491 million has already been spent. If I look at the laboratory, it's 66% done, complete, and the completion is targeted. It's on track to be finished by Q4 2026. The ruthenium circuit, 60% complete. We are on track for targeted completion of Q2 2027. The rhodium-iridium circuit design is 98% complete, targeted completion Q4 2029. And these are exciting projects which will really modernize this facility and give it the right reliability as well as flexibility to produce the metals that can be marketed at value. I'll end here. Thank you very much. I'll hand over to Richard.
So I think you can say, wow. I think it is quite overwhelming when one considers what a privilege it is to be a mining professional in South Africa when you can work in such an opportunity. Current operations that are delivering to expectation, compelling brownfields execution. I mean, the quality of the brownfields projects, the IRRs we're talking about, the net present value, the life of mine, 7 compelling growth opportunities. Our chrome is not just, what we think about, but, something that is definitely in the future going to be improving margins and strengthening our project economics. So bringing it in all together, we can see a compelling, sustainable, robust, enviable PGM business for the long term. Current operations, the 2 operations in execution, the Siphumelele and the Thembolani, and then all the other projects that we've described. Robust, high value, very exciting future ahead of us. So this is not just about a portfolio of mines. We are executing a deliberate strategy to extract more value from every square meter of resource base. As I've said, how are we thinking about chrome? It's no longer just a byproduct in our thinking. It's a deliberate additional value stream that improves margins and strengthens project economics. Bobsy shared with us where we're going to, where we see a pathway to becoming in the top 5 significant chrome ore producers in the world. Just in PGM, this is a very enviable capital expenditure program, aligned with the guardrails of expenditure, but have a multi-year 8 to 9 billion per annum capital expenditure. That's very exciting. It's about the stuff that gets our legs swinging out of bed. How are we going to do it? How we need to set ourselves up that in the very near time, this becomes real on the front line. Very inspiring to be part of it, and I'm sure we're the envy of our peers elsewhere in South Africa. So very exciting. Existing underground and surface projects added to that, projects currently in execution. K4 proved that we can execute. Both Sipho and Thembolani, that'll prove that we can scale that execution across the footprint. Projects that are in feasibility studies, pre-feasibility studies, as well as concept studies. The reason why Ralph is the executive head of projects, looking exclusively at the grow out of the SA PGM business. I think this is largely an underwhelming slide because I don't know if words can capture what we've got and where we're moving to and why we're so excited about it, but I'll give it a go. These are long life, contiguous assets we've currently got a significant production base. We've thought about it a long time, how we can unpack and unfold those operational synergies that underpin our cost competitiveness. We've got a significant resource endowment that we've shown today. We've got an unlocking brown project opportunities across Mount boundaries. They're shallow, and they are also obviously also strike extensions. Our project execution strategy is well thought through. It's on the back of looking at a strategy. How do we win over that endowment? It's optimizing for market demand, capital allocation, as well as existing infrastructure. It's quite flexible. If market conditions change, we can pull back. If they expand, we can lean into that as well. Very competitive. It focuses on a high revenue UG2, low capital intensity, mechanized brownfields projects. K4 is very important. It demonstrates to a team that has been extracting how to build and execute projects at scale. Followed with Siphumelele and Thembelani, that advanced the next phase of underground growth. Again, further value creation and how we've strategically positioned ourselves, the partnerships that we've entered into. We're very excited about the chrome market. And we're busy building a substantial secondary mining business. You see what DRD has been able to do in gold, we're going to do that in PGM. So we've got a long life, competitive SA PGM platform. We've got clear levers currently underway to sustain that production, as well as improve margins and drive further value creation. So in summary, we have a very high quality underground PGM business, long life assets, solid operations, delivering season in, season out, a credible brownfields growth pipeline backed by a super passionate team that's excited to work in the PGM environment. Quality underground. We've got new surface business emerging. We've got extending the resource base, creating a meaningful new value stream at scale. And chrome is now becoming a strategic value driver. More and more, it's enhancing our basket and supporting the growth and strengthening the competitiveness of our SA PGM portfolio. So in essence, we've got a quality underground portfolio. We've got an exciting new surface value business, and chrome is becoming strategic. So thank you very much, ladies and gentlemen. That's the PGM business. Appreciate it.
Thank you, Richard and team. We'll start with questions from the floor again.
Hi, it's Arnold again. I've got a spate of questions. Do I run through a few?
Yeah, sure.
Okay. So quick one, just on Mimosa, 8-year life of mine. How long can you extend that to if the Zim government plays ball? And then just looking at the projects, there's a lot of legacy infrastructure there. There's a lot of development, and I fully understand the synergies and what you're trying to achieve. But you are still sitting with a lot of infrastructure. And how do you manage the cost around it? Because every shaft is an overhead, and every time you drop down, it adds cost. So, are you rationalizing some of that? Because it looks like you're almost going the opposite of rationalizing. You're reutilizing and reopening or opening up some of those older infrastructure. And then just a quick one on the tailings deposition into the pits. Do you have permitting for that? And then on the chrome side, two questions. The one is, are you tied to Glencore? And the second one is, with your projects on the chrome side, can you buy yourself out of the discount sooner? In other words, can you produce more metal to get to full payability sooner, or you're locked into that time frame? Sorry, lots of questions, but I think they're all relevant.
Arnold, thanks. Listen, I'm only going to touch on some of the strategic stuff. The team will have to answer the rest. So guys, please prepare for that. Let me just touch on Mimosa, because that is I guess, comes down to a strategic decision as well a little bit. And listen, I think, the current Mimosa has got potential to expand. So they've got a significant project called the North Hill project. At the moment, capital for North Hill has not yet been approved by the shareholders. I think from an asset perspective, it's a great project. Whether or not, we are going to touch on at the end of today a little bit around what we're presenting now, and perhaps I should just give a heads up. We're showing you all the projects, all the capital that goes with this. We're going to be ending with a bit of a discussion around how we're thinking about capital allocation. So I think that's just key to pick that up at the end as to how we wrap all of this up together. Please don't be sitting there thinking what you're seeing necessarily on here is exactly how it plays out and gets spent. That's just a key part of today I should mention. But as it stands at the moment, North Hill is not part of our capital allocation. So it's definitely got opportunities as a project, but Zimbabwe investment for us today is not a priority. So that's just how I can answer that one. I think, listen, team, do you want to answer the rest? I could maybe just touch on Glencore as well. Bubsy, you touch on it, just in terms of how that agreement works. But it's delivering a volume rather than buying ourselves out.
So, I've got something. So thanks for that question, Arnold. So the first one, in terms of being tied to Glencore, yes for some of the assets, no for some of the assets. So all our surface assets is not included. We can select to make it part of the agreement or not. And then your next question, can we buy ourselves out earlier? Yes, we can. We've got that optionality built into the contract. Obviously, it will depend on value, price and value, whether we do it sooner or later or not. But we do have that optionality, yes.
Okay, but volume, if you push volume, let's say you're very successful with project, and you bring online additional volume,
Yeah.
does that get you out of it quicker or not?
It can. So the contract itself is linked to certain mining rights. But we've got the optionality now to bring others in if it does make sense for Sibanye. Yes.
Yeah, so you can deliver additional material on top
We
of
can.
that to pay it off.
Yes, we can.
I think there are two important points there on Arnold, just to touch on it, because it does give us flexibility. So the value for Glencore in terms of how, why, that green bar you saw in the graph continued for life on that. So we effectively put a hard stop to it. We can bring it forward by committing additional volumes to it. So we could take volume from other sources and put it in there. So a high PGM price environment, for example, you could put more chrome in there. But the flexibility we've got is the new projects are excluded from that legacy contract if we want to. Okay, so what that's given us, and this was the key to unlocking a lot of the project work, is it's given us the comfort to be able to start those projects knowing that we can get full chrome revenue going forward, which reduces a lot of risk to PGM volatility. So we've got a lot of optionality to be able to play with. If you're in a high PGM, lower chrome environment, you could easily try and settle that quicker. But we've also got the flex on the project side, which gives us confidence. That was the value for us in that agreement.
Okay, perfect, that's it. From those.
Adolf, maybe I'll just pick up the deposition in the pits. So we can't deposit there at the moment. So we've got two licenses, one with the DMRE, the other one with the Department of Fisheries and Industry and Environment. So there's a program of engagement, but we don't yet have those licenses, but there's no expectation that there'll be a pushback.
Ngatakumatonsi, Investec Bank. My question is for Lucas. The first question is for Lucas. You indeed have presented that you have excess refining capacity, both BMR and precious metals. I just want to know, in terms of your risk assessment, because part of the reason, in my knowledge, part of the reason you've got excess processing capacity is because there's a significant amount that is still toll processed into Valterra. That contract has been renewed, but it is not for a longer period. I think it's about 4 to 5 years. So should, for for whatever reason, that contract not be renewed, what does it mean for your processing infrastructure? And also, I wanted to know some of this, the additional volumes that will come through, or the new projects. Will those metal be processed at Sibanye, or does some of it actually form part of the tolling with Valterra? So the question is, does Valterra actually get higher tolling quantities as a result of the replacement projects that we see? And then, Richard, am I correct in actually assuming that from Sibanye, for the next up to 2034, production actually moves sideways? So in terms of that decline that Clienta presented on the supply-demand balances, that actually would not be coming from Sibanye because of the new projects, your production actually moves sideways. You did say that, yeah, my question will be answered during the presentations. Thank you.
Yeah, I think for the first question, I think just to be clear, we are very comfortable with where we are now in terms of the projects that we have, current operations. Are we going to be able to push the metal out right to the end? So we've got the solution, current solution. So we are not really, we don't see the risk as well. But having said that, I mean, obviously we consistently review our strategy in terms of what makes sense. Do we utilize industry capacity? Do we employ capital to increase capacity? I think all of that is actually part of the ongoing considerations that we'll continue to do. But we are very comfortable with where we are. We are secure in terms of that will push the metal. And if different decisions have to be made in the future, we'll certainly make them. I think we are not tied to any of the solutions. It depends on the strategic decisions that we take at a particular point in time. Coming to the future projects as well, I think also it is really about what makes sense, what can we bring in, and what can we do probably with our partners as well. But at the end of the day, central to it is what really captures us the great value. But I think the important thing is we don't see ourselves at risk that will be desperate, or I think we're comfortable where we are. Thank you.
And Kateko, maybe, I mean, just to add to that one a little bit. So the Valterra tolling contract runs until 2032. And that covers anything that comes out of Rustenburg today, combined Rustenburg-Kroondal. So any new projects that deliver from that will automatically go into that contract. And that comes out of Marikana, automatically goes into our own facilities. Beyond 2032, I think, is what Lucas has just been touching on. We've got several options, as to how we can look at processing that. Investing our own capital, continuing to toll, that's going to be a value discussion, but plenty of options to look at it. So we're not concerned around how to solve that, which I think is what Lucas was just touching on. So we're still going to get to as I mentioned, the last point around how we think about capital allocation. But let me start answering your question now. Because I think what we're showing here, and this is why I'm going to suggest it up front, that this is one of the best portfolios in the world. I mean, as Rich just mentioned, how many single mine complexes have you got that can build a world-class chrome business, third biggest chrome business in the world, a whole new DRD? And we can maintain a production rate. Here we've modeled 1.5 million ounces. The reason the 1.5, that matches what we think the market needs. But we can maintain 1.5, not out of a single project that's either commit or don't commit huge capital, you're in or you're out, but out of 10 projects that can be turned on and off, brought in at different times, ramped up or not. So that's the flexibility we got, and that's why I said this is one of the most amazing portfolios in the world. What we've committed to today, so what the board's approved in terms of capital, is what's in execution. I think Ralph took us through that. So the 3 projects today have already got board approval. Where we stand today, we think that 1.5 is a good level to maintain at. So to answer your question directly on that profile, we dropped from about 1.8 to about 1.5 versus today. So there's a small portion of that comes out of ours. But that we will continually monitor. We've got the resources. If we wanted to ramp up, as Ralph mentioned, we've got opportunity to grow, get back to 1.8 and stay there if we want to. If markets don't require it and go down, we've got flexibility to delay some of those projects and go a bit lower. So those will be decisions as we complete these projects that will be taken with the board. So today, committed from the board, are the 3 projects you saw in execution. Our target, our strategy is to maintain about 1.5, but of course those are decision sort of hurdles we'll go through as that capital gets approved by the board, and we'll show you what that profile looks like right at the end of the day. Does that?
Thank you, Richard. Maybe one last question, sorry. A very attractive proposition as far as Chrome is concerned. It looks like regulation may be changing, so maybe if you can talk to that and potential impact. Nothing, I don't think anything is finalized, but from the communication, it looks like regulation on Chrome pushing for beneficiation may actually be changing. Does it, would it impact your business?
Yeah. Listen, it wouldn't impact our business, in terms of what we're producing, etc. What it could do, and this is a message we must be clear, listen, that regulation makes 0 sense, and I'll quite openly say that. So our problem is not whether we have chrome available in South Africa to produce ferrochrome. There's plenty of chrome. Trying to keep some of it here and not sell it externally is not the problem we've got. So putting taxations, putting export quotas on chrome is going to make no difference to promoting beneficiation of ferrochrome, because availability of chrome is not the problem. We can see that. So it doesn't solve the problem. Let me just state that up front, and that's something we'll continue to argue against. The risk with putting it on is that, like I say, part of the reason why the Glencore CMA was so important to us was it allowed us to ring fence these projects and be able to start them up because the chrome removed some risk to PGM price volatility. That was a critical decision in being able to start those. If that's taken away through regulation, it'll put those projects at risk. Now, those projects today can employ anywhere between 8,000 and 10,000 people. And this is what South Africa and regulations need to understand. By putting those regulations in place, you are not solving a beneficiation project. Let's be clear. It's not about availability of chrome to beneficiate. What you are doing is putting projects that could put anything at 8,000 to 10,000 people at risk, just within our portfolio. I'm not even talking about the rest of the industry. So no, it wouldn't affect us today, but if those regulations came in and did impact prices, effectively, yes, then it could be putting future jobs in the entire PGM industry at risk.
Suraj Ray from BMO Capital Markets again. There's 4 quick questions, if I may. First, on the production profile you saw, talked to, both at Rustenburg and Marikana. In terms of your throughput, can we expect at Rustenburg to remain steady around that 850 kilotons per month, and for how long? And the same question for Marikana is it going to be around that 570? And for how long, with including those projects? The second question is on your capital and cost profile. There's an increased capital profile over the next 4 years as you do a lot of the development going to mechanized mining. What does it do to your cost, for example, in terms of rand per ton? Where does your mining cost go from where you are today to where you will be in 2030? And 2 questions on the processing side. See the change in mix between Merensky and UG2. Based on what your smelter technology or processing technique is today, does that make a difference, or do you need to change any changes you need to make to your smelter as I understand, there's a certain amount of sulfide feed you need. Does that change anything in your smelter infrastructure? And the last one on the chrome recovery, you talked about increasing recovery from mid-teens. With those applications of all the improvements, where does it get to?
Yeah.
Maybe I can add on the smelter. So clearly the smelter, we have got a study underway to consider what the reaction will be with an increased UG2 loading, chrome loading, and exactly when we take the chrome out of the loading, what impact that does. But clearly there has to be some response from the smelter, and we've got a study underway. We didn't present it here. We don't have headroom in the smelter. There would need to be some changes made, but we'll present that strategy. On the cost profiles, I think those are very important questions we don't want to get wrong. So maybe there's a workaround between now and next. We can hand those to you. I don't think we can flatline it. I think it is dependent on production profiles, and we don't mind sharing that. And then the capital and the cost also as well. I think those are quite important discussions. We'll get that data to you. Don't mind sharing that. Thank you. Was there any others that needed to be?
So on the chrome recovery, as I mentioned, we've got a couple of chrome recovery plants, about 12. We see anything between 2 and 36% yield for the total of Sibanye, between 12 and 15. So the potential really depends on the head grade to a large extent. So plants where we've got between an 18 and a 24% feed grade into the plant, you can easily, if you deploy this technology, you can easily get between 30 and 40% mass yield. If it's a bit lower, it will be a bit lower. So it's really plant dependent, and we will obviously be targeting the areas where we can yield the most, and we've got the best. And I don't know if you can recall the slide that Lucas showed with the head grade on the various tailings dams. Obviously, the ones with the higher head grades, we will see a better yield, and we will target them first. Thanks.
I just want to do one media question. Okay, thanks.
Sorry, Ed Stoddard with the Daily Maverick. I just wanted to ask regarding chrome, and it being becoming such a strategic part of your portfolio. Just wanted to ask about concerns around the extent of illegal chrome mining, especially around Rustenburg. The illegal chrome, I presume, if an export tax is brought in, will be exempt from it and give them give these guys a competitive advantage. But I'm also wondering, just in general, how big a concern is it? I mean, is it potentially a material issue to Sibanye and other legitimate chrome producers? Thanks.
Ed, thanks very much. And so let me try and pick that one up. I know we all smile when you say that, but it's a really good point that you raise. And in fact, I mean, I think as an industry, that's where we've been quite supportive of saying, listen, if there's an export quota that comes in to manage illegal chrome, that is something we would be in full support of. An export quota to try and manage how we market and sell our material is a completely different issue. So you're quite right. Listen, a significant portion of chrome, and I'm not going to quote the numbers now exactly because if we quote those, let me get them right. We do have them, but how much illegal chrome actually goes out of the country? It is a significant concern to us, Ed, yes. The Western Limb has not been quite as badly impacted by illegal chrome mining as the Eastern Limb, but there's no doubt across our properties it pops up. And it's a real problem for three reasons. Number one, obviously the criminal element it brings. 2, the environmental side, and 3, safety. And not just in terms of illegal mining, but in terms of infrastructure. So there has recently been press around, an operation that we manage, a tailings or a waste facility, and illegal mining that's happening on our boundary that risks collapsing that facility. Now, I mean, these are serious concerns around infrastructure, safety to people and safety to the environment. So yes, it is a real issue for us. It's a different problem to what we see in the Eastern Limb, on the Western Limb side, but it remains a real issue, I believe. But I mean, you have to get input from themselves. But Sibanye-Stillwater, on the shallower up-dip side, has also been having some real challenges. But listen, they'd be able to obviously give more input than that. Raj, maybe if I could just. Raj just shut off. Just to pick up on the question around the costs, I mean, part of the reason we haven't given a consolidated cost profile in here is because it does depend on which projects, of course, kick off. So we've given you the profiles for all of the individual projects and the costs within there. And we will be showing you what our assumptions in terms of projects that are starting up are, but there is the flexibility to be able to include that in any model, which is what I think Rich alluded to, that we'd be happy to share going forward.
Thank you, Richard. Ben?
Thanks. Ben Davis from RBC. Two quick questions. Just with the taking of Ivan Platreef's phase 2, what does that take your base metal refining capacity? I mean, is that from 50% to 80%? Just curious what that number is. And then also just the impact on those recovery circuits on ruthenium, iridium, rhodium, etc. Just curious, again, what's that impact?
I mean, let me give it a crack. I actually don't know the exact number on BMR, but we are so far below BMR capacity, we don't get anywhere close to being near capacity with Ivan Plat. So, listen, we can get you the exact numbers, but that is far from our...
It won't be pushing you at all?
No, not at all. Not at all. And I mean, in fact, listen, that's probably a question that I'm sure is on, that needs to be asked. And I mean, the smelter was alluded to it. Our constraint in terms of processing is smelting capacity. And it's not just a throughput issue, it is also this mix issue around UG2. So today we're running at, I think, Luke, as you said, at 78% or so capacity. So if you were to try and combine everything, that's our bottleneck. BMR, we're probably the only ones in the industry that have got significant spare BMR capacity. That's the bottleneck for most. And PMR, there's spare capacity across the whole industry. And I think this is why, listen, I've often been quite vocal about saying, and the question, what happens beyond 2032? And why I've been quite vocal about saying, if you look at all the profiles in the industry today, we've got plenty of processing capacity in the industry for the industry. We don't need new smelters. We don't need new BMR. We've got enough. We're closing down smelters in some places. So it becomes around, if we have to rely on ourselves and process all of our own, we can, through a bit of capital investment in our smelting, which is our bottleneck. The rest is fine. Is it optimal? I would argue there's a far more efficient way of understanding that by sharing existing infrastructure. Otherwise, you're all losing. And this is the conversation that I often have around saying, I think we've got to start looking at this capacity, not as a strategic issue. We no longer rely on capacity to control marketing, which was the case 15 years ago. Today, marketing is spread across the board. We should be looking at it as a cost and an efficiency issue as to how we optimize our costs across the industry. So we've got options, but ultimately it'll come down to an economic decision rather than a technical one, if that answers your question.
Oh, and just on the recovery circuits, any on the terms there? Just with the ruthenium circuit that's coming in, I'm just curious, is that just a change in terms of what you're recovering? Yeah. Yeah, okay.
Thank you.
Hi, it's Steve Friedman from UBS. Thanks for the opportunity. I suppose one of the things looking at the presentation so far, the economics presented for the brownfield project pipeline appear to be driven largely by attractive capital intensities and, as Arnold mentioned, the ability to leverage existing infrastructure, processing capacity, etc. I suppose the question to Richard is, what differentiates these projects from previous generations of development within the region, Rustenburg and Marikana? What gives you and management confidence that the stated capital intensities, the timelines can actually be achieved?
You want Richard Cox? You can talk.
Ralph, what do you think, Ralph?
I can come in here.
Just want to check if he's on. Thank you.
All right. So, as already mentioned in the presentation, we're quite well aware of the structure we go into. We have previously sunk these declines as well. We have previously sunk Merensky declines as well. So we have a good idea, first of all, what we can expect when we build it. In Sibanye-Stillwater, we actually also follow quite a rigorous assurance process. So when we do these studies, obviously, we take into consideration. We do the best capital estimates we can. We bring it to what we call a Class 2 estimate. We actually go through a double layer of assurance review before we do capital approvals. Obviously, there's always room for something which can go wrong, and hence the reason we also allow for capital in reserve as well. But the process we follow itself is quite rigorous before it gets to the board, before it gets approved, and that includes third-party reviews as well. Thanks.
Maybe just one more to add to that. I think, Steve, what's changed? And I think this is something that really needs to be understood, because if I just go back, when we bought Rustenburg, the whole sales pitch by Anglo at the time on Rustenburg was what was called the UG2 extension. So that was all about using the Merensky infrastructure, going underground on UG2. We could not make that project technically work. Rephrase that. Technically, you could make that project work. Economically, it was incredibly difficult. And it was difficult because of the time to ramp things up, the time to get underground. You couldn't pull the projects together to get capital, a return on your capital. It was just incredibly difficult from that perspective. What's changed now? Why can we do it now? It's having the Aquarius infrastructure next door. That is the huge change and the breakthrough that's happened. Okay, so when you look at it, we now just continue mining. So Aquarius was due to be closed in 2026, between 26 and 28. We paid R1 for that infrastructure, and what you've seen today is going to be mining for another 20 years. That's what changed it. So it's no longer about going down a vertical shaft and starting development. It's about simply carrying on. That's how you get that mass production that's come through. That's why it works. That's why we can now make it work. So it's a completely different project compared to what was looked at 10 years ago, and that's the value of dropping the boundaries. Lonmin is the same story. When we looked at Lonmin, they were pushing to get up to 1 million platinum ounces at the time. There was a very good reason they needed that. It was to sustain their own processing capacity. That was the minimum number they needed in order to sustain themselves as a business. The fact that that's now a third of a bigger complex means we've removed that constraint entirely. That constraint, those costs, that desire is gone. So we can build this up at will. So now it's not about needing to do 4 projects at once and how do you manage 4 projects with a certain ramp-up profile, with a big capital hump in front of it. We can bring them on in staged fashion, which completely changes the risk profile of those different assets. So I think what's critical here is it's not, Ralph's just given you why technically we're confident, and certainly because of the technical capability Ralph's got and his team and running through that makes me sleep at night that we've got the technical in place. But even with that, if we hadn't put these 3 assets together, we couldn't have unlocked this. This would never have worked. So that's the crux around why this has become available. And right up front, we said putting contiguous assets together was one about realizing operational synergies. We've done that. We've got the 3 billion a year. It's locked in forever. That's done. But dropping mine boundaries is where the real value comes from. And it's taken us 6 years to get to this answer. I think that's one other thing that needs to be appreciated. This is not just spreadsheets that we've done a project, modeled it and said, well, here's a profile. 6 years of running optimizations, looking at processing capacity, looking at chrome, looking at technology for chrome, bringing in the surface, looking at deposition to get to these answers. And that's why it works. It's looking at this as one new mine. It's a completely different way of looking at it. Does that make sense?
Yeah, thanks. Yeah, maybe, I mean, just on E4 and how that sort of goes into sort of creating incremental value. Is it the same thing in terms of just leveraging off existing, synergies, or is that seen as sort of a new project entirely?
So if you only look at mining, obviously it is a new decline from surface. But again, as we discussed, we sit again already with the management and labor, which over time would be converted to mechanized mining. What is not new is basically the processing, to process that, because that will go to EPL. But the mining skills and expertise which is going to build East 4 is still within the Western Limb complex. And I think that also gives us a significant benefit so that you don't have to start from scratch to do this. It's probably one of the biggest benefits that we sit with the expertise and skills at Marikana and Rustenburg to actually execute that specific project. Thanks.
Thank you.
It's Brian Morgan, RMB Morgan Stanley again. Can we just chat on K4? I think the capex was going to be finished at the end of 2025, and it's been pushed out another R1 billion to spend by halfway through 2027. So can you just chat on that, were there scope changes or just what's happened there?
Yeah, thanks, Brian. I think the biggest scope change was the movement out of specific ventilation shafts. So those would have come in earlier. They were postponed, which actually made more sense to do them a bit later. So that was probably the biggest item. Then there were some other smaller change of scope items, but that's where it comes from. Despite that, the timing to get to steady state in 2021, we said it would have been around 2031. So we're still around 2031, 32 on that. But at a stage, there was a deliberate decision specifically to move out the ventilation shafts. Then the other portion was as technology improved, so what we expected underground for shaft switches and care and maintenance. For example, your safety devices at a shaft station, your station D, so that gates moves further away, so suddenly you need more space for your material cars. So we had to go back and actually develop additional space for material cars as well. And then always for care and maintenance, you never know what's behind the seal. And as soon as we've broken those seals, in fact, the deterioration was much more than what we expected. So those were the major items which actually added to that. But in terms of building up to a steady state position, we're still in line for that. Thanks.
Hi, good day. Bruce Williamson, Integral Asset Management. Richard, I'll address this question to you. Can you just confirm that you own 100% of all the mineral rights, or are there still some niggling minority rights that are sitting in that pool of rights?
Yeah, Bruce, I'm going to just ask somebody to kick me if I'm getting this wrong. But as far as I'm aware, obviously we have different empowerment agreements on the various mineral rights. So we do have empowerment partners. So Marikana, well, in total they're all around 26%, Marikana and Rustenburg. Kroondal was amalgamated into Rustenburg. So that sort of almost, when originally Kroondal did not have any empowerment, it was a spin-out of empowerment from the Anglo days. But when we amalgamated that into Rustenburg now, that got empowered in the same way as Rustenburg, so the same partners and the same agreement. Outside of empowerment partners, I'm not aware of anything else that I think, as far as I'm aware, we own, all of the rights. I'm not aware of anything else.
Okay, good, thanks. And then just in terms of labour, I mean, you've got a massive labour force there, 44,000 on the PGM side. Post the days of hostels, I mean, how are your people accommodating and housing themselves? Are they right there close to the mine? Do they live in Rustenburg, Brits? Can you give us a bit of a feel?
So I think from a SAV perspective, we still got active SAVs around, especially our big conventional operations. Majority of our people stay off mine in either accommodation that we provide as the company or self-funding accommodations. So majority of our people either stay in Rustenburg, Mooinooi, and then we've got also people staying close to Brits. That's where our workforce are staying currently.
Okay, thank you.
Excellent. Thank you very much. No more questions? Oh, there's one at the back of the room.
Dave Roche-Kelly from Phoenix Research. Would just like to say thank you very much to both Richard and the team for this quite amazing presentation. First of all, thanks for the detailed technical stuff. I personally, and I'm sure many people in this room will have many days of headache trying to absorb all the details you've given us. And also very impressed to hear details of so many different projects. It's very encouraging to hear that so many projects have been worked well down the line. So my final say, if I may say, is the best of luck with all your new wonderful projects. Thank you very much.
Thank you very much, and thanks for the support. Much appreciated. If there is no more questions in the room, a question on the webcast was regarding the project costs. So I think the only comment there is we did provide cost up to what was in resources and in execution. So Sashi, that question of yours is included, it's in the deck. And then we'll move to lunch at the moment. So we'll come back in 30 minutes, so 1:45 South African time. We'll be back and we'll start with the SA Gold operations. Thank you very much. See you.